Hi everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate speak. Today we are diving into Form 10Q. Get ready for some twists because this company seems to be juggling more balls than a circus clown. Who knows what we might find buried in the numbers. They're a clinical stage biopharma firm developing treatments for tricky brain disorders like suicidal depression and PTSD. But lately they've been singing a different tune, one that involves clinics and a whole new line of business. They are basically switching from just being a drug company to running clinics that use their drugs. And that is quite a twist. Before we begin, if you're all about getting straight to the point with corporate documents, subscribe to the channel. We also have a Discord community. The link is in the description below, so come join and say hi. This is NRX Pharmaceuticals report for the quarter that ended March 31, 2025. It's basically a quarterly checkup, so let's see what the doctor found. First off, NRX Pharmaceuticals says they are developing treatments for central nervous system disorders. They name suicidal depression, chronic pain, PTSD, and even schizophrenia. Now they're also in the process of opening medical clinics. It's like a restaurant that also grows its own ingredients. They created a subsidiary called Heart Therapeutics, which will run these clinics. They want to go from just a drug company to a company that makes drugs and treats patients. This might give them more control, but it also adds a lot of risk. Okay, so the big question, are they sure they can keep the lights on? Well, here's where things get a little dicey. The report admits there's substantial doubt about their ability to continue as a going concern for the next year. Translation, they're not entirely confident they can pay all their bills, they're burning cash, have a working capital deficit, and they haven't made any money. They need to either get their products approved, get acquired, or find someone who can write big checks quickly. They've taken on some debt to buy themselves some time, most of it from something called Anson. This Anson debt needs to be paid down. So it is very important to watch how that deal goes. Let's talk about the numbers. It's never great when a company uses words like estimate and judgment a lot. These are the points where the company is making some decisions with a lot of assumptions on what the future will be, and they are required to do so because it's impossible to know the future. If the estimated values are off, that can cause big problems down the line. So let's see some of those estimates. Here's the quick and dirty. They have about $7.6 million in current assets, the largest one being cash at $55 million, and they have $32.8 million in liabilities. That difference, about $25 million, is their stockholders' deficit, meaning negative net worth. As Warren Buffett said, it's only when the tide goes out that you learn who's been swimming naked. In this case, it looks like they might be caught without swimming trunks. Let's move on to their income statement, a breakdown on where their money is going. They lost $5.5 million in the last 3 months, about $6,000 a day. Their research and development expenses are down, but their general and administrative costs are still pretty high. It cost about $3 million to keep the lights on and make sure everything is running properly. But what's this? Almost every single item down there is related to finance, debt, or shares. It looks like their finance department is working overtime with all this debt. How did the cash flow look for the last 3 months? They burned about $3.5 million to stay afloat. So their $5 million in cash won't last long if things don't change. Their financing activities are what kept them alive, bringing in about $7.6 million from Anson convertible notes and the registered direct offering. So it all looks like debt is keeping them alive. Now let's look at this Alvogen deal. They had a licensing deal with Alvogen, but Alvogen called it off. That means the almost $5 million they had on the books as a refund liability is still there because they may owe it back. They have a bunch of debt, which they call the Anson convertible promissory notes. In order to pay the old debt to Streeterville Capital, they took on the new debt from Anson, which is the main thing keeping them afloat. Shares. When in doubt, issue more shares to raise money, right? It's hard to read a clear message other than to delay the inevitable. Speaking of shares, they did give some stock options and awards to employees. Stock compensation is an odd expense because it doesn't cause cash outflow at the moment, but the company is giving part ownership to their employees. For a company in so much trouble, one would think they would be a bit more careful with their ownership, but perhaps they're giving it away to retain talent. They are obligated to pay these folks when they reach certain milestones. For example, $500K for the commercial sale of their product. Since they have very little revenue, this number is worth a mention. Their chief executive officer is the one calling the shots and figuring out where the company is headed. The way they measure success is by tracking how much money they're spending on research and development and other general business activities. It's important to note that their operations are solely conducted within the United States. And just to top it off, after the quarter ended, they sold even more shares of common stock. They were only able to find a buyer for a bit of it, so this tells you how the market likes this company. Now my take's up, there's a lot of ifs in the report, which are code words for we don't really know what's going to happen. Are you a risky investor? Their stock might be for you since there might be a moonshot somewhere, but I wouldn't bet any money I wasn't willing to lose. They are trying to turn the ship around by focusing on clinics and hope that it will be a game changer for them. This involves buying several clinics. So far, though, they've just signed agreements. It is very important to understand how that transaction will work. One of the biggest risks is the amount of debt they have. The deal with Anson seems to be the only thing keeping them alive, but it's a double-edged sword. If they can't start making money, that debt will crush them. If those risks pay off, there might be a good opportunity here. In conclusion, this company is currently very risky and not safe for investment. I would keep this on my watch list, but not in my portfolio. Alright, that's our breakdown of NRX Pharmaceuticals' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.